Hey guys, welcome to a new video. So a few days ago, I did a video on TSYX here and TDAX, which are the light leverage funds of the T-SPY and TDAC ETFs, the income ETFs from the Tap Alpha guys. And I was thinking about my strategy behind it, and I was thinking about building a little framework. And so I've created a little framework, and of course, I've given it a little name as well. It's called the Fear and Yield Framework. So that's what I'm going to be talking about today in this video. So, of course, before we get into it, there is a disclaimer. This is for educational and entertainment purposes only. This is not financial advice. This channel is purely based on my thoughts as I navigate my own personal journey. Please always do your own research. Very important. Right. Okay. So let's get into it. The Fear and Yield Framework. What is it? Well, it's very, very simple. I like to use the Fear and Greed Index as a very basic tool, a very basic indicator. It isn't the only one you should use. I just think that if you're using if you're starting somewhere, this is just a very basic tool and indicator to use. Now, it's not for every single fund. It shouldn't be used for like everything, depending on, because obviously there are different variables involved. Like REXSHARES has a different strategy to Granite Shares, which is highly volatile, super big distributions. There's loads of NAV decay, loads of NAV erosion. So the strategies and the tools that you use should differ depending on which ETF you're getting into and your own personal situation, your own personal circumstances. So I'm just going to keep it very simple. I like the Fear and Greed Index because it keeps things simple for like mum and dad investors like myself. And so that's what I'm going to talk about. So this here is the Fear and Greed Index. You can see it under these two boxes I've created here. This is it, the CNN Fear and Greed Index of the stock market. This is it over the past year. So you can see in April, when we had all the tariff stuff, it was an extreme fear, a score of 4. Extreme fear. Everyone thought we were going to a recession. It was a great time to buy. Amazing buying opportunity. Now, recently, we also were in extreme fear in November 20th. 5, extreme fear. Again, a great buying opportunity. These are the times when we're in greed, extreme greed up here. This is greed. Probably good times to sell. This is a very basic concept. You know, you need to do more stuff than this, but just from a very basic fundamental point of view, this works quite well. Now, so currently we're in greed. We're just above neutral. We're in greed. So I'm not doing a lot of buying now. I'm actually not buying at all at the moment because I'm trying to build my cash position. But in this greed and extreme greed, I'm probably not really buying too much. But that's what we're going to talk about. Okay, so this is the Fear and Greed Index below. You can see it's the same one as this CNN Fear and Greed Index for the stock market for the whole timeline for the past year. That's what this is here. Okay. So all I've done is created 2 boxes. So I've created a box to buy T-SPY and TDAC. So these are the unleveraged ones. So anything over 35, anything over the level of a 35 to 100. So we're currently in, what did I say, 56? So we're currently here somewhere. I would be buying, based on this framework, T-SPY and TDAC, and I would be staying away from the light leverage. When we're under 35 to 40, depending on, you know, whatever levels you want to use, you should base this on your own risk tolerance, your own circumstances. Between 0 and 35 or 40, I would then be dipping into the light leverage. Why? Because in here, in these times of fear and extreme fear, is when the better buying opportunities are, in my opinion, according to my research and according to data and history, right? So around here, if you're buying in April and you're buying a leveraged like TDAC or T-SPY, a leveraged version. So these ETFs, I did a video on this a few days ago or a week ago. These are light leverage versions of these. This is the S&P 500. This is the NASDAQ 100. These are the income funds from Tap Alpha. And these two are the leverage versions of these. They have an extra 30% exposure. So they are essentially 130% leveraged. And so if T-SPY goes up 10%, TSYX will go up 13%. Likewise for TDAC. If TDAC goes up 10%, TDAX, which has that extra 30% exposure, should go up 13% roughly, depending on also what they're paying you in terms of distributions. So if we buy in this zone, then obviously I'm going to have more upside opportunity when the fund starts to recover. So here, and if I'm DCAing into the leverage ones here, then when it comes to recover, I'm going to get more of that upside. The reason I don't want to buy the leverage ones in this zone, in this neutral greed and extreme greed, is because when it comes down, I'm going to also, that leverage also exists, right? So there's more risk. So if TDAX goes down 10%, TDAX is going to go down 13%. So I don't want to be buying it near the tops when the market's in greed. I want to be buying it here when it's in fear, so that I can ride it back up and use that extra leverage. This is a very basic framework based on leverage. I'll buy leverage in this section, and I'll continue to buy. These are S&P 500 and NASDAQ 100 funds, right? So I'm going to continue to buy them. I'm not going to sell them, but I've also done a little chart for the rest of the high yield ETFs. So here we are. This is what it looks like. I've taken that kind of concept and built it out further. Now this is kind of just a working concept, if you like, and this is by no means concrete. And like I said, there's going to be lots of variables depending on which fund companies, if you like Roundhill, if you like REXSHARES, if you like Granite Shares. It's all going to be slightly different depending on what you're investing in, your risk tolerance, your personal financial situation, all those sorts of things. But I'm just going to keep it very simple. Okay, now there's a number one rule to this: cash buffer. Keep at least 10% in cash during neutral and greed conditions, which can be deployed during conditions of extreme fear. Why? Because we want to be building a cash position during these times, so that when we go into these times of extreme fear, we have a cash reserve to deploy so that we can benefit from these amazing buying opportunities. These could be potentially lifetime buying opportunities. If the S&P and the NASDAQ went down 20% during the times of the tariffs in April, so that could have been, if you'd held a big cash position and you deployed that around the April time, look at that recovery. It did amazingly. And it's always been the case historically that the S&P 500 and the NASDAQ, the stock market, is essentially always recovered. I don't have a crystal ball. This is not financial advice. Please do your own research. This is just a basic framework that I'm going to try and abide by this year and stay away from. So I made a few more risky moves in 2025, had too much exposure to crypto. So I'm going to try and have some more rules and little frameworks like this involved so that I don't get so annihilated by crypto and some of the Misties and the Conies of the world. So what does it look like when we're in extreme fear, when we're between extreme greed? So this is extreme greed. When we're between 75 and 100, as you'll see here, extreme greed, 75 and 100, we're not there yet. We're currently at 56, just at the beginning of greed. Then I would be selling a percentage of single stock ETFs. So your WHOs, your PLTWs, your MSTWs. Now, this isn't going to mean that every single stock, every single underlying is going to be Robinhood's going to be going up in extreme greed. It's cyclical. Like crypto is cyclical. Palantir, it may be doing very well. Not every single stock is going to be doing very well in extreme greed. You're going to have to play this by ear and be like, okay, we're in extreme greed. Which of my single stock ETFs is doing really well? You know, is it way above my average cost price? If so, can I sell a percentage of it whilst we're in these good times, whilst we're in this euphoria, whilst we're in extreme greed? And that's just my perspective on it. I want to be selling not all of it, just a portion of it. Maybe take 10% off if we're in like the bottom of extreme greed. And then if we get up to like crazy times and the market's absolutely euphoric, I sell 20, 30%, depending on how the underlying is doing. If WHO's jumps from what it is today, it's about $48, $50, and it jumps up to $90, I'll be selling 10, 20, 30% of that position. Of course I will, because we know that it's such a volatile stock, such a volatile ETF, that it will definitely come down again at some point when we're in extreme fear. And then I have the opportunity to buy into it again. So that's kind of a rule of this framework: sell a percentage, depending on what's happening with the underlying, with that in ETF, sell a percentage of the single stock ETFs. Now, why have I said single stock? Because the NASDAQ 100, your TDAX, your QQQIs, your T-SPIs, your SPIs, even your chippies, I probably wouldn't be selling them because they generally don't have as much volatility. They don't have as much NAV decay or NAV erosion. They are quite profitable. There's no real NAV erosion, so they're up and to the right generally. Just keep on investing into them, the safer ones, the safer yield ETFs. Okay, next. So that's extreme greed. Next is greed. DCA small amounts into lower risk funds. So e.g. your TDAX, your T-SPIs, your Maggies, your Chippies. So this is where we're in greed. So the market's doing well, but I'm not going to be buying into the single stock, the really risky, volatile single stock funds. We're in greed, so the market's in a pretty good position. I just want to DCA small amounts into the NASDAQ 100, the S&P 500, the Mag 7, semiconductor funds, maybe gold, maybe silver income ETFs, and just do it like that, DCA into them. All right. So that takes away the kind of the risk of investing and buying into single stocks when the market's doing pretty well. Now, we're getting into the more fear areas of the framework. So between 25 and 50, that is fear. So we reinvest distributions and DCA into core income ETFs. For example, NVII, TSII, WPay, blocks. So we start getting into the single stock stuff, but your core positions, maybe your WPay, so your basket leverage fund, blocks like Bitcoin, crypto, if the cycle, obviously there's nuance to this. You need to do your own research. Are we just going into, a Bitcoin and a crypto bull market? Are we just coming into a bear market? Because crypto doesn't always follow exactly what the stock market is doing. So you need to be careful about how you play this, which funds you're getting into. But in terms of, this is just reinvesting distributions and DCAing into the core income ETF. So if your core funds are NVII, TSI, WPay, Chippy, Maggie, you're investing into all of them in this period because there's a level of fear. The likelihood is that the market will recover at some point to go above neutral to greed. Not all the time. That's why we're just DCAing. We're not buying heavy here. We're just DCAing and reinvesting our distributions. That's all I'm doing. This is just my basic framework. And then when we get into extreme fear, this is where the real opportunity is. This is where the market's down, retail are selling, people are selling their positions because they think we're going lower, we're in a recession, tariffs are absolutely killing the market. Maybe, I don't know, the next crazy thing has happened. We're in a world war. Who knows what's going on, right? With Trump in power, we don't know what's around the corner. So anything could happen. But something crazy is going on, and we're either in a recession or we're in a big drawdown, a big correction, a big pullback, and say the NASDAQ's down at least 10, 15%. I don't know, whatever. We're in extreme fear. This is where we buy more heavily into high conviction ETFs that have large drawdowns. So say we're big on PLTW or Tesla, TSII, and they've gone down massively in price and we're in extreme fear. This is when you're going to be using that cash reserve that I'm currently building myself at the moment. I'm building up my cash reserve and deploying it heavily into the income ETFs and also the growth stocks and pretty much everything that you believe in, Bitcoin, gold, stocks, whatever, your income ETFs, your high yield ETFs. In this time, you want to have a cash position ready so that you're ready to deploy it into these times of extreme fear. And so that way you create the opportunity for when the market recovers to get back up here and to be pretty profitable, both in terms of your yield and both in terms of your share price. Because once they recover, which historically the market has always recovered, then you should have both a positive NAV price and be getting yield and income from it on a weekly basis as well. So that's it. It's an important rule. I've tried to keep it very basic. This is not financial advice. This probably needs some work, but I just put it together based on some of my thoughts from the video the other day about, we had a couple of comments about when buying leverage and using leverage and when not, and thinking about when to just buy T-SPY and TDAC and when to buy TSYX and when to buy TDAX. And then I thought, why not just evolve it into the rest of the yield portfolio and all these other income ETFs. So just some of my thoughts that I thought I'd put down into a framework. Let me know what you think. Let me know what your plan is this year, if you have some rules that you're following, or if not, if you're just kind of winging it and playing it by ear. But anyway, I'll leave it there, guys. Hope that's of some value. And please like and subscribe, and I'll see you in the next one. Cheers.